Hi guys, welcome to As Simple as Possible. In this video, we are going to discuss about gearing ratios. What do you understand by the term gearing? Gearing means debt. Simple term, gearing means debt. Why do we calculate gearing ratio? Because we want to know what is the percentage of debt in our total finance that we have. Total finance means debt plus equity. Simple terms, debt divided by debt plus equity is gearing ratio. Here on the left side, you can see I have just provided you a small snapshot of a balance sheet. We have assets, we have liabilities, we have debt, we have equity. So in the liabilities section, we have equity and reserves, and another term that we have is non-current liability. The third thing that we have in liability is current liability. These are the three things that we have in the liability section of the balance sheet. So when we divide the non-current liability, which is debt, divided by the non-current liability plus equity, we get the gearing ratio. Now, why do we want to calculate the gearing ratio? As discussed earlier as well, gearing ratio helps us to know what is the amount of debt that we already have in our balance sheet and if we should take any further decision on the sources of finance that should be used for future investments. That is, whether we want to take debt or equity. If we see that the gearing ratio is already very high, then we will take a step back and think whether we should take more debt or we should go for more equity. We already know that debt holders they require interest. Interest is tax savings, so might be that it would help us to take more debt, but only to some extent, because there are many factors which avoid us from taking more debt, which means there are many issues that should be considered before taking more gearing. There are four practical issues. There is an acronym for learning or for remembering these four practical issues. That is LOSS. Stands for life cycle. O stands for operational gearing. S stands for stability of revenue. And the last S letter, it stands for security. First one, we will discuss life cycle. Life cycle of the company. That is the meaning of this point. In what stage of its life cycle is the company in, so that we can understand whether we want that or not. For example, if a company is in an introductory stage, it is not possible that it will get more equity holders. Why would someone want to invest in that company? Like for penny stocks, nobody wants to invest in penny stock, they are risky. So obviously, in that case, gearing would be preferred. Second, operational gearing. If already in currently we have a lot of gearing, we will think about taking more debt. Third is stability of revenue. If I know that I would be able to give my pay my EMIs, for example, I have a good amount of salary. Say for suppose I have a 1 lakh salary, and I have currently I'm giving only 20,000. My other expenses are zero. Maybe I would prefer that I'll take more EMI. I'll pay more interest. It's okay. I can just manage it with my salary. So I can take maybe a 20,000 more amount of EMI. But I will not prefer it if I don't have a stable revenue. In case of a business, if I am struggling right now, I would prefer equity because equity holders, it's not that they want a fixed amount of dividend. There are equity holders that they want who want a share price yield. Why would they want to give up the share price yield if they want that they want to stay for long term? There are equity holders who just play on the basis of the share price and they don't depend on the regular level of income or dividend. So that is why stability of revenue matters. So in short, in summary, I can say if don't have stability of revenue, Maybe I will not consider taking an additional cost of interest on myself, and I will go for equity. The last point, security. This is in simple terms, we can say if there is a sense of security among the equity holders that they will get their money back, and it is secured, maybe we can get more amount of equity. And if the debt holders they are secured, then maybe we can get more debt, because if they are getting a regular amount of interest and they see that if we have a good amount of credit rating as well, that also matters. There is not only credit rating for market share, but also there is credit rating for debt holders. So that is why the security plays a role. That if we are in terms of the whole scenario, the shareholders or the debt holders, they are secured. Then in that case, they feel secured. Then in that case, they can take more amount of debt. So these are the four practical issues that we consider before taking on more gearing. This was all about this video. I hope you found the video useful. In times when you want to just learn about gearing ratio just before your exam, you can just scroll through this video. You can bookmark this video. You can just scroll through this video and you'll get to know what is gearing. You'll be able to write at least 2 or 3 points about gearing ratios. You will try, if you listen to the video carefully, you will never forget this topic. This is very simple topic, but and yet very interesting. So this was all about this video. Please do comment, share, and subscribe the channel. And of course, thanks for watching.